Hello, this is Matthew Chan
and Wes Weaver.
Welcome to the newest episode of the TurnKey Investor Show. And in this episode, we are going to talk about non-traditional financing. In the last episode, if you've watched it, we talked about traditional financing and we talked about the different products and our view of, we gave it kind of an overview opinion of what was going on there. Well, in this episode, this is meant to be the bookend to the other episode. We're going to talk about how we view non-traditional financing and how we used it to build our own portfolios. Mm-hmm. So Wes, when non-traditional financing talk comes up, what comes to your mind?
I guess
something good or something bad?
No, it's always, with me, it's usually always good first. I like to be optimistic before I'm pessimistic, but with me, the whole OPM, other people's money. That's really what comes to mind. Whether you're using other people's financing, other people's cash, other people's credit. These are all non-traditional that inject some outside form for you to get the deals done.
Well, I got to tell you, with a couple of exceptions, this is my turf.
Yeah,
this is my turf. I feel I'm pretty good at it. Mm-hmm. I feel like I'm pretty creative. I've got all kinds of weird ways of thinking about it, mm-hmm. and so this is just my little domain. Mm-hmm. I love non-traditional financing. Mm-hmm. Now, I like non-traditional financing because if you master this and understand this well, potentially the number of properties you can buy is infinite. Would you agree with that?
Absolutely. You don't have anyone putting brakes on you as far as, at least, like we talked about earlier, FHA or VA or the banks, lenders, and things like that. There's potentially no limit to what you can do.
Right. There is no limit. And that's one of the things that I feel that doesn't get discussed enough. Now, certainly, if you look at the real estate investor education market, there's all this talk about, there's no money down, and you don't have to qualify. And yes, part of it is true. Part of that is true. But really, I think that ultimately, long term, you have to look at it from a whole bunch of different angles, mm-hmm. right?
Yes.
And now, Wes, you touched on it on the last episode about how you kind of concocted your own little system, the Supercharger Portfolio. Now, I didn't know what you were going to say, but I think what you were going at is you just picked and choose the tools, use the best of both mm-hmm. to achieve your ends. Was that where you were going, or did I misread you?
No, that's kind of where I was going. So we were talking about traditional financing there. Here we're talking about mm-hmm. non-traditional financing. And so, mm-hmm. To get kind of technical, obviously traditional, I had a system of taking down deals using conventional financing. Just finding the deal, put it under contract, got a loan from the bank, and closed it. So on that sense, we were cranking out some closings. Then over here, we had non-traditional closings going on to where we were buying subject to wraparound mortgages, contract for deeds, mm-hmm. and things like that. And so by using both of those, basically when I found a house that I wanted, if it was for sale, I wanted to have a way to buy it.
Right. You put on your thinking hat to figure out which way you can do to take this thing.
If we could buy it non-traditionally first, that was the first route. But if it was just some smoking deal and we had to have it, I had investors lined up. We were already qualified. I had pre-qual letters ready to go, and they went with the offers, and we could close them that way. So
now, just to make sure we're on the same wavelength here, when you said you used traditional financing to mm-hmm. take down deals, they were not your deals, with the exception of like maybe 2 or 3 deals. You used a partner,
yes,
a credit partner for such a deal. So as far as you were concerned, mm-hmm. It wasn't you qualifying.
No,
it was somebody else qualifying, but you were putting the deal together.
Absolutely. You have a credit partner who has a piece of the deal that they're W-2 people that I wasn't W-2. Great credit that wasn't being used.
Yes.
Great source of income, low debt to income ratios, mm-hmm. and personal, friends, people that's a big part of it. But that could be a whole segment of getting involved with people who you don't know.
Yeah, we don't need to talk about that. This is from a purely financing, and you use somebody. It was not your credit.
It was not me, right? It was other people who I cut into the deal. They were ready to go. They said, "Hey, I want more houses." So you had people lined up, pre-qual letters ready to go. So when I was finding deals, if we couldn't buy them non-traditionally, I could fire a contract and we could close it in 30 days.
So would you agree that that's one of the things that to this day we agree on? In our philosophical, we love non-traditional finance because we don't like being held back.
Yes.
we don't want some bank telling you, oh, you know what, you have enough, that's that.
Right.
Have a good life. You're limited to 5 houses the rest of your life, or 10 houses. That is not the way we want to live life. We will decide where the limit is.
Right.
Like today, my portfolio is at a certain size, and I'm pretty happy with where I am. Doesn't mean it won't get smaller. Doesn't mean it won't get bigger. I'm just happy where I'm at.
Yeah, when you can really master the non-traditional ways of buying houses, you can, exactly, it gives you the power to say, okay, well, I'm comfortable with 10 houses, 20, 100,
right.
Whatever it may be.
You get to determine the number,
right.
But you have to learn the tools, okay?
Yes.
And, okay, so let's drill down to this. All right, I've broken this down to like 3 general areas, which works a little bit with traditional finance. I've got cash partners, down payment partners. Actually, cash partners and down payment partners are pretty similar, and the credit partners. So let's start off with the credit partners. Well, you touched on that. It's basically getting somebody, obviously someone that's interested in working with you, to go through the loan qualification process. It does not involve you to be signing on the loan. Now, I'm sure the question will come up and say, well, why would anybody want to do that?
All right.
What's your answer?
Well,
I have my answer. I want to hear your answer. Why would anybody want to do that?
It comes in the way you pitch them, but typically they're willing to do that because they want a piece of the action. You've got to offer them something. Rather,
they don't want to do the work.
They don't want to do the work.
Right. They don't want to do the management. Right. That's the reason why they will do it. Now, if you're going to pitch this to some guy that wants to do all the work, or part of the management, it's gonna be a little bit tougher, wouldn't you say?
Yeah, you guys, you'll find yourself kind of butting heads. So the perfect kind of people to look for are people that they want to add something to their investment, whether they have their 401k or whatever it may be. You make them pitch them, hey, have you thought about adding real estate into your portfolio? Right. And you say, well, hey, look, I'm good at analyzing deals. I'm good at management. I can walk you through the financing of kind of getting qualified. But yes, they're the ones that are signing on at the end of the day.
Now, what do you think about down payment partners? And I guess some people, I hear this more in the larger deals, but basically, the down payment is so large, right. It's hard to come up, even though they're okay with signing on the line, but they just don't have the down payment money. What are your thoughts on that?
That's true. And yeah, coming up with down payment money, you can burn through, a possible investor pretty quick if they're having to come up with, 10, 20% down. So keep that in mind. But I would not get involved, probably, this is me personally, with getting, investor A to put up the cash, investor B to get the loan, and then you're the management, and I don't know if that's where you're going with it, but that gets a little...
I wasn't necessarily going anywhere with it, but I do know that down payments are an issue for some people, and I just at least wanted to touch on it, what our positions are on down payment partners. The thing, I think I kind of agree with you in one regard. The down payment partner, if I'm short on down payment, I'm not necessarily going to cut them in the deal. I'm going to try to work out, say, look, I need $5,000 or $10,000.
And work out
can I pay you 12%?
Right, work out an interest rate, something like that. Yeah.
And people are going to look at this and say, what? You're going to offer 12%? Well, what you have to do is you got to look at the whole deal. Yes, it's 12%. The whole deal is not being financed at 12%.
Right.
Actually, a very small portion of it.
Right.
So when you actually look at the blended rate, and one of these days, we may get around to actually teaching what a blended rate is. But and the overall blended rate may actually still be rather small.
Right.
But of course, it goes to the deal, which how good your deal is, which we talked about a couple episodes ago.
Yeah, depending on kind of how much cash they're putting up. But yes, in my opinion, the credit partner is, I would say, kind of a little more important, or they have a little bit bigger piece of the deal than the cash partner. I mean, because that credit that they're putting on the line, I value a lot. It's very
we agree on that.
Yes.
Yeah, I mean, it is hard to quantify the value, but yes, I would say that I do value credit partners more than cash partners.
Yeah.
And and the thing about it is, and of course this is my experience, but I find that people who have a lot of cash sitting around, just kind of sitting around, when they want to do a deal, they want to get it back.
Yeah.
They're not into parking. Whereas the credit partners, they're okay. As long as the loan payments are being made and their credit is up, they're okay.
Right.
But the guys that have a whole bunch of cash, what they want to do,
it around.
Well, they want to go into foreclosure. They want to buy properties, spend a lot of money, turn around, and then out you go. But if you're trying to build a portfolio, I'm not saying that can't be done, okay? But for me personally, I just didn't want. I already had another business to run, all right, and I was already busy enough. I didn't need to take on buying a deal and getting out of the deal and all this stuff. Although it is a good way, it could be a way to raise cash for yourself.
Right.
But that's just my take on it.
Yeah.
I like credit partners better if I had a choice.
Yeah. And then if you're really creative enough, you can still do creative financing with a credit partner and not need a down payment partner, even if neither one of you you nor the credit partner has cash, which was kind of in my situation. But that's it can be done.
Yes. All right, let's talk about hard money lenders. What do you think? I don't think I've ever worked with a hard money lender, but in concept, I put them on non-traditional financing because they're a little bit different than the traditional guys, the banks and lenders. But in some ways, they also they kind of operate in both realms. What do you think about hard money lenders as you understand them?
Hard money lenders kind of have their own little world and rules they go by. I mean, when I kind of think of a hard money lender, I don't think of like a loan shark or anybody, somebody like in the mafia or things like that. But they kind of have their own.
It's more expensive money.
It's more expensive money, and you're dealing if you're going to pitch a hard money lender, you're dealing with smart guys. You're typically dealing with people who have a lot of cash. They've done a lot of deals. They very likely are smarter than you, even in the deals that you're doing, I think.
Yeah, I think I agree with you. The hard money lenders, as I know it, they usually come from people that have done some deals. Yes. So they kind of been an investor, but now they've got some money. They don't want to be so active.
Right.
They'd rather have their money.
They have possibly been through the motions that you're going through. They've made it somewhere through whatever way, and they're willing to step back now and loan the money out to guys, doing deals. But you better have your ducks in a row going to a hard money lender.
Yeah. Okay. Good. All right. So moving on to the next phase of this, I want to talk about part of the non-traditional financing is the seller financing or owner financing. Now, I like to use the word seller because I don't know, if the seller is selling, that's the way I look at it versus owner, because I kind of look at us being the owners.
Sure, yeah.
But I'm not, and if they're selling to us, we want the ownership. So anyway, there you go. That's why I don't prefer the word owner financing. I like seller financing. Now, I think the where we started out with in seller financing was subject to mortgages. Now, for those of you who don't know what a subject to mortgage is, it's really a way of taking over, assuming a non-assumable loan. That's really what it is. You're taking over a loan without any of the liability, and no, you're not asking permission from the bank.
Right. Exactly.
And you know what? I probably just made like a few people just go into a tizzy. They said, "What? What did he just say?"
Right.
You're assuming a non-assumable loan, and you're not asking for permission.
Well, the word "assume" that you're using is kind of making me cringe here because people when you say "assume," people in their brain they're thinking that I'm taking on this debt and I'm taking it on to me.
Well, we kind of are. We kind of agree to that. It's just not. But anyway, go ahead.
Okay. Well, but you're not assuming the debt. You kind of are. You're being responsible. How do we explain this? Maybe we should lay this up.
That's all right.
You're becoming responsible for it in a way through your moral obligations that you're making in the deal. But you are on credit. You are not assuming or responsible for it, if that makes sense.
Well, I'll try to say it
you
simply.
are contractually responsible.
You're not, as far as the lender's concerned, you don't have any formal responsibility.
Yes.
And that's really, I kind of look at it as a responsibility.
Yes, it is a.
Okay,
it is
big picture, you're responsible.
Let me go ahead and say, taking over property subject to, in my opinion, you have a bigger responsibility than you're on your own loan, possibly that's with your own traditional finance. Reason being, if you decide to ruin your own credit, well, that's on you.
Well, that's true.
You know what I mean?
Yeah, you don't have to ask anybody's permission.
If I took over Matt's loan and I say, well, just screw it. I'm going to quit paying on Matt's loan. That to me is worse than not paying on my own loan. Not to say that I would protect Matt more than I would protect myself. But it's just it's a.
I agree with you.
It's only, buying subject to is for the best of best. If you're crooked or you don't have a high sense of responsibility, it's not for you.
Yeah, it definitely, it does attract, if you're kind of an unsavory type, there's a lot of destructiveness and that a lot of damage you can cause by getting into this, so. But, you and I talked about this really early on, and we really, we take our responsibilities seriously.
Yes.
Doesn't mean that we can't have setbacks in life, but we really have intense discussions about covering things.
But subject to for us, and just so you know, that was kind of the heart of mine and Matt's buying process. I mean, that you're in the people business when you're in the subject to business. And yes, you are in the real estate business, but you're going to get involved with these people. You're going to know their lives, and you're going to become a problem solver for them. And it really, when it works great, it's great for everybody. It's a wonderful tool.
Now, we're not going to get into the intricacies of how to do a deal and all that stuff in this video. I mean, we did want to at least touch on it.
Yes,
we may get into the intricacies maybe on some future video or course, but at this point, because of time limitation, we just simply want to touch on the concept. It does exist. I'm not trying to sell you, but I do have a book on it called The Subject to Mortgage Handbook, which is available on Amazon.com or my website, TurnKeyInvesting.com, if you want to know more about it. Now, another thing that we really like in the absence of the ability to subject to mortgage is wraparounds. As a matter of fact, we've not only bought using wraparounds, now we're selling using wraparounds. And for those of you who don't understand what a wraparound is, what it is, it has a little bit more teeth than the subject to. Okay, it's still not technically, you're not taking formal responsibility, but there's a little bit more teeth to it in that that you can get foreclosed upon. A property can be taken away from you and so forth by the seller. Whereas the only person that you could be liable for, at least that could take any action formally in a subject to mortgage, is the lender itself. But in a wraparound, you are accountable to the lender, the bank, and the person that sold you to the property.
Right.
So, now, without getting overly technical about wraparounds, what are your opinions on wraparounds?
Yeah, wraparounds, again, like Matt said, they can be a great tool, and I like to teach people to start from what best is for you and then work your way down. And and wraparounds to us, it's not the first way we go into looking at buy property. So I don't want you to run out there and say, oh, well, I want to buy
a wraparound.
Yeah, I want to buy a wraparound. I mean, that's not what you want to do first. But yes, in the absence or a deal where you have two like-minded people and you want to make the deal work, and they say, well, I'm just not going to sign my deed over to you. Talk. This is where having your tool bag full of tools where you can close deals that other people can't close. And that's what Matt and I want you to do. We want you to go to the table with so much knowledge and information that you can close them. So a wraparound mortgage is something that when a deal starts to go sour, you can reach back in your tool bag, pull it out and say, boom, what about this? And that might be what gets you that deal.
Right. Now, I also, Wes touched on it too. Yes, wraparounds is not the first thing you want to go shooting out the door with.
Yeah.
And the biggest reason is that a lot of people to this day still don't understand it.
Yeah.
I mean, a lot of realtors, and you're a realtor.
Yeah.
I mean, if you said the word wraparound mortgage, I would say, yeah, most of them, and he's in the community, he knows a lot of the folks, they're not going to know what it is.
And the term wrap, just in case you're wondering, you're taking a mortgage and you're wrapping another mortgage around it. That's kind of where the term comes from, if you can kind of envision that. So.
Right. So, it requires, in many cases, if you can engage in some of these types of non-traditional financing, you have to guide some of these. Now, it doesn't mean you have to dot all the I's and cross the T's. Okay, you still want a closing attorney.
Yeah, but that's
a real estate attorney.
Even with the attorneys,
but
you're going to be.
You have to be the guiding force.
You're going to be guiding even the attorney of how to
That's
close
correct.
it. You may even have to give them some sample contracts for them to kind of go off over to draft up. Absolutely.
Okay. So now, how about buying property with lease options? What do you think about that, Wes?
I think it's a terrible idea. I mean,
for a long, long time, I said I wouldn't want to do it. And you know what? As a general, I still, it rubs me the wrong way. However, I've talked to a friend of mine, investor friend, a couple of them, and they did paint a couple of scenarios where it would come in handy. Now, I want to qualify by saying that the person that if you're going to engage with a lease option, it can't be some flaky person. They've got to be somebody reputable.
Yeah.
Okay. Now, if you're getting like a home, forget that. Someone unsophisticated, I wouldn't do it. But it was someone sophisticated, and the only case to be made is to get into that property, get it controlled, and see what it's like. So if you want to get out of it, you can get out of it fairly easy. But that's the case. What are your thoughts? You're making a funny face.
I'm making a funny face. I'm making a very funny face. I mean, buying a lease options, it is. I mean, if you just want to like go in loosely and you say, well, I'll give you $1 down and $10 a month. I mean, whatever. I mean, I'm being very ridiculous here, but you don't want to go throwing a lot of money and time and energy maybe into a lease option. I mean, because a lease option, as a buyer, you are not in a position of strength. So, again, if we're coaching people, to go in and building their portfolio, I mean, I really just, I mean, a lease option. There's got to be better deals out there you can do without
twitching. He's twitching all over the place.
I mean,
just look at this video. Just blow up this video. You're making him squirm. Okay, let's be honest about it. You're squirming.
Let's just say don't do it. I mean, I mean,
no, because if we're coaching, okay, let's do this. All right. As a general rule, I agree. Don't buy a lease. As a general rule, if you're a beginner, don't do it. Just forget it.
Yes.
But I believe that as your sophistication goes up, I don't know.
It can be done.
I've talked to, I have a lot of different investor friends throughout the year, and they're pretty smart. Right. And I don't necessarily agree, but my thinking is I'm willing to at least listen.
Okay, but look.
But at least I know it's a tool in a tool bag. Now, will you likely see me do it? No. Probably not, but I don't know.
Right.
I'm not switching as hard as you are.
I mean, I guess it's possible, but for me personally, there's really not a deal that I would think I would have to have bad enough to reach way back in my tool bag and pull out buying on a lease option. It would have to just be something crazy that I just kind of have to have, and I'm loosely interested.
Well, it's not. I mean, the way it's been painted to me is it's not so much about what you got to have, it's what you're willing to let go. Because if you get into a wraparound mortgage or something else, it's a little bit harder to unwind.
That's true.
Okay, it's not so much the getting in as much as the getting out.
That's true. I guess.
And Wes.
Well, that's true. I guess
times are different.
Yeah.
There was a time we never talked about getting, but now,
I guess if you maybe want a deal that you want, your exit strategy may be out the back door, then I guess buying on a lease option can happen. But just realize that when you buy on a lease option, if the seller decides to make it difficult, I don't care what you have on paper that they'll sell it to you. You don't want to get involved, you got this great deal, and then you're at odds with the seller not wanting to sell. And then you're under, suing for performance and things like that, and a lease option is just a very loose agreement.
What you're talking about is a sandwich lease option. I'm not necessarily talking about a sandwich necessarily. If I wanted let's say this,
I wasn't even thinking of a sandwich, but.
Oh, okay.
I mean.
Well, let's say, for example, I look at a property and I want to create a storefront. I'm going to lease it, and because I'm not committed to buying it, I'm going to lease it. I want a storefront, but I want the right to buy it.
Yeah.
Like if I bought a restaurant or a laundromat or something, I'm going to rent it. But you know what? If this business takes off and it's self-sustaining, I think I want the option to buy it.
Yeah.
So this restaurant or laundromat or whatever business this is, I have the right to buy it. But just because I'm in that business doesn't mean I don't want to sell it.
Right.
So I don't know.
I will say I have.
But it's not so much to turn it out to somebody else. But go ahead.
I do have one positive thing to say. Is that lease options, or buying on a lease option or controlling a property lease option, will be an easy way for you to probably have a conversation with the seller. I will say that. I mean, if you start talking about wraps and subject to, you're going to blow their gasket as far as what they're comfortable with. But so I will say, talking about lease with options to buy or things like that, you can have a comfortable conversation with most people. So that part of it I like. Because it made me think about when you were talking about a business or things like that, or even with a house. Most homeowners, they understand a lease. Okay, so if they understand that, then all you have to do is inject, okay, well, can I have the option to buy it? And under these terms. So in that sense, you may find you may find yourself able to talk to more sellers to get more deal flow with lease options. So with that part of it, I like, because you can have a conversation with more people.
Okay.
If that makes sense.
Yeah. No, definitely. It's way easier to understand.
It is way easier, yes.
Now, as we close this video out, I'm going to want to get Wes's parting words. But the reason why I feel it's very, very important is, especially now more than ever, okay, qualifying for a loan is incredibly hard. All right, and even back when it was booming, I was still a big proponent of learning non-traditional financing. Well, here we are in 2011. You've got to learn. As far as I'm concerned, and I'm not even necessarily talking about the buy, even selling. unless you've got very nice property serving, A credit worthy people, even selling is going to be a problem.
Yeah.
I mean, you're in it.
Right.
So if you want to get out of the property in some way, shape, or form, without short of getting cashed out or just waiting for somebody, doing creative financing on the sell is a nice middle ground. You don't have to own it. You don't have the liability.
Right.
You're just the lender.
Right, that's a tool.
And you have a nice thread. I love it.
I mean, that's a tool that Matt and I have used, in the recent years, is offloading some of the properties that we weren't that in love with to other investors and letting them take them on.
Well, in fact, what we did was we created equity where the properties didn't have that much equity because we controlled the financing. Right. We were able to create an interest rate spread, and I don't mean to get technical, okay? But we're kind of short on time. You can create an interest rate spread. You can create an equity spread on the price. I mean, there's so many ways of profiting if you know how to structure it right.
Absolutely.
So what are your closing comments about non-traditional financing? I mean, we've talked so much about partners, and really, this is the tip of the iceberg. I mean, so much.
I mean, each one of these can
it could be an episode all by itself.
I mean, my closing points or arguments would be to read. I mean, just pick a topic, start looking, just put it in, Google search engines, just read, or buy a book, or I'm not going to say go buy this big course or anything, but just start reading, start becoming knowledgeable. If you don't know anything, I mean, you can't learn less. So become knowledgeable, even if you learn, this is something I'm not interested in, because someone may try to sell it to you that way, so you need to know.
Yeah. And when you do non-traditional financing, I mean, the one little thing, I think we touched on it, is just because Wes and I are very knowledgeable in this and we know how to guide and all this, make no mistake, we use a real estate attorney, okay? Because it's not that we can't do the details ourselves, but if something were to go wrong, or a deal that just there becomes a dispute, there will be no question that this was a legitimate transaction. No one can say that, I didn't know what I was signing and that kind of thing.
Even if you're buying on a loosey-goosey lease option or whatever it may be, I mean, having a closing attorney can bring some legitimacy to your closing.
Oh, it's huge.
Pay a couple $100 or whatever it may be, and just go into an office and have an attorney close it for you. It'll make you feel better. It'll make the seller feel better, and everyone will just feel the deal is much more solid.
Okay. Well, thank you, Wes. I appreciate it.
Yeah.
And thank you, viewers, for joining us on this episode. We hope that you enjoyed this episode of Non-Traditional Financing. As a reminder, go look at the previous episode to get our take on traditional financing. All right, on behalf of Wes and myself, we'll see you in the next episode. Thank you.